In this video, we're going to explore what goes into developing an investment idea or investment thesis. So let's get into it. Just a quick recap though, recall that we said data-driven investing ultimately involves creating and implementing investment strategies that are statistically valid or statistically sound. And we talked about a systematic 5-step process for data-driven investing, where we start by developing an investment idea or an investment thesis, and then create a testable hypothesis before extracting and cleaning relevant data, and then estimating relevant measures that relate to our core hypotheses. And it's after that, once we've done all of these 4 things, that we can actually go about testing and validating the hypotheses. And of course, once we've tested and validated the hypotheses, then we've got the statistics as proof about whether or not an investment idea is worth pursuing. Now, all of this starts with an idea, right? Or of course, a few ideas. But where do we actually get these investment ideas from? Well, there are a variety of sources, the first of which, and perhaps one of the most common, is of course experience. Right? So working with stocks, exploring stocks, analyzing stocks over a long period of time, you start to understand what sort of characteristics can impact or can influence performance, and what sort of characteristics or attributes don't really matter. So experience would be one, knowledge would of course be another, and then we can get it by reading and observing information on forums or news articles, as well as the research literature, and pretty much anything where people are posting opinions or factual information in the context of stocks or financial markets or investments in general. Remember again that at this stage, when we're just ideating potential possibilities of what might end up being good investment opportunities or what might end up being good investment strategies, at this particular stage, no idea is particularly crazy, right? Because we can always test it later on in the data and see whether or not there is actually merit to the idea. But it's perhaps not very constructive to, just dismiss an idea because you don't like the idea. Or it doesn't quite make intuitive sense immediately. So be open to getting these ideas from a multitude of sources and places, including from just simple conversations with a mate, or indeed John from the bar, or I don't know, some person you just meet on public transport, on a bus, on a train. It really doesn't matter, right? The idea is to be free with the creativity and to let the sort of creative juices and the imagination do its thing, right? Because again, we'll validate the ideas and test the ideas later on. Now, of course, telling you that investment ideas can be generated from these different sources is one thing. Putting it into practice is, of course, a whole other ballgame. And so to kind of give you a feel, to give you a sort of idea for what it's like to generate these ideas from these different sources, I thought I'd share a pretty recent experience that I had actually that sort of got my creative juices kind of flowing and got my imagination flowing a little bit. And this is in fact what we're going to be using for the rest of the course as well. Okay, so this is the idea that we're going to be working with and testing as we progress on. Importantly, at the time of recording, I haven't actually tested the hypotheses yet, right? So I haven't actually I haven't even created the hypotheses, to be fair. So I'm kind of creating these slides and walking you through the data-driven investing process as I go along, mainly because that's more representative of the actual real-world data-driven investing and data-driven investment analysis, right? Because when you've actually got an investment idea and, when you actually then formulate it into a testable hypothesis, you don't actually know if the thing works. Right. So, that's why you're testing it, right? To see whether it actually works. And so it would be very easy for me to, try out a multitude of different investment ideas and hypotheses and then only show you the ones that actually work. But, although that could be interesting, that's not really representative of the real world, because when you're actually conducting research, when you're actually implementing data-driven investing, you have plenty of questions, but you don't really have answers. Okay, and of course, it's a two-part thing. It's first about asking the right questions, and then, of course, going out there and exploring the data and answering the questions using data-driven techniques and by relying on the statistics. Okay, but again, I'm just going to walk you through the investment idea that came about into my mind by relying on these different sources. And so just a few weeks ago, I was actually having a conversation with a friend of mine, and he talked about corporate governance as being one of the key factors in making good investment decisions. So he talked about this idea that firms with good governance will be better investments vis-a-vis those with poor governance. Right, and of course there's a multitude of different ways of measuring whether a firm has good governance. And just in case you're not familiar with corporate governance, it is a field in and of itself, but it's essentially a variety of different regulations and legislations that companies must follow, and these regulations and legislations were introduced to hold firms accountable and to prevent them from taking part in fraudulent activities. Right, or embarking in fraudulent activities. So it's about stewardship. It's about getting firms to not do illegal things. It's about getting firms to do things that are in line with the law and in line with what's in the best interest of investors. Okay, now I am simplifying corporate governance a tad bit, and if you are someone from the corporate governance environment, or if you have a corporate governance background, then maybe you're cringing at the way I've described it, but please do keep in mind that this is a finance and investing course. It's not a corporate governance course. And so, I'm trying to keep things fairly simple here when I describe corporate governance, right? But the key idea really is that it's about holding firms accountable, and it's putting legislation and sort of regulations in place for firms to, be in line with the law and act in the best interest of shareholders and investors. And so one of my friends suggested that firms with good governance will be better investments, right? So if you want safer investments, if you want a good bang for your buck, if you want a safe long-term investment, then you should look at the governance of firms and pick your investments that way. Now, this is not something new. This is sort of well established. So we know that governance does matter for things like financial performance, and firms with good corporate governance will be less likely to take part in fraudulent activities. Of course, it still happens, right? So companies still do fraudulent things and still end up being fraudulent despite the presence of corporate governance. But this is an idea that many people have. It's a notion that many people, including my friend, have, right? And so I thought, well, of course, one way to explore this is to discuss and debate the, merits and demerits of corporate governance and, make an informed decision that way. But of course, you can alternatively let the data do its thing, right? So let's actually explore in the data and see whether or not this is true. Does governance actually matter? Are firms with better governance actually better investments? Answer, I don't know, but we'll find out, right? The point is that this is an example of where we're sourcing an investment idea from something as simple as a conversation with a friend. And, after I had this conversation with my friend, I then thought, a little more into it, and then you kind of explore what's out there in, say, forums, or what's out there in the news, or what's out there in research articles. And so one of the themes at the time of recording is, of course, climate change and, sustainability. And so there's this notion that in an increasingly climate conscious world, companies' environmental policies are vital for their long-term economic performance. And because, or rather if the company's environment policies are important for their long-term economic performance, so for their profitability, for instance, or for their long-term financial sustainability, then of course it's reasonable to see and expect that this might be important in the context of returns for investors as well. Is it definitively important? I don't know. This is an idea, right? It's a hunch, it's a notion, it's a premise. Later on, we'll kind of formulate a hypothesis that kind of relates to these kinds of investment ideas, and then we'll go out and collect our data and, test and validate the hypotheses. But again, the point is that this is a sort of investment idea, right? It's an investment thesis. So maybe there's something to do with firms' environmental policies, right? And maybe that can sort of distinguish a good investment, so to speak, vis-a-vis a poor or a bad investment. Importantly, again, I'm not saying that this is valid, right? I'm just saying this is a hunch, this is a notion, this is a premise, this is an idea. And similarly, if we look at the research literature, then there's plenty of evidence about the fact that firms' corporate social responsibility or CSR policies do actually matter for their firm performance, right? So there's been plenty of work that's been done in the academic literature as well as in the practitioner literature on the importance and value relevance of corporate social responsibility or CSR. And so what we've got right now is, just ideas that are kind of in the air, right? So there's some kind of investment idea or investment thesis about things like corporate governance and environmental responsibility and social responsibility, and how that may relate to something to do with investments, right? And how that may, for example, tell us something about which firms we expect to perform better in the future as part of our investments, right? And which firms we should therefore choose to invest in. Now, some of these investment ideas, you might argue, already make perfect intuitive sense, right? And so they don't need any further digging. You might alternatively be thinking that some of these ideas are totally ludicrous, right? And they make no intuitive sense whatsoever. I don't know what exactly you're thinking right now, but I think it's reasonable to say that there are some investment ideas that are perhaps easily intuitive and easily understandable and easily agreeable right from the outset. And there are other investment ideas which perhaps aren't as agreeable, at least not right from the word go. But I think regardless of what sort of investment idea you're looking at, when you're developing the thesis, when you're developing the investment idea, it's always a good idea to start by asking why. So why should this particular investment idea or this particular investment thesis work? Why do we think it might hold in the data? Why do we think there might be some sort of merit to this investment idea? Note that I'm not saying we're definitively concluding that the investment idea is worth pursuing, right? That's what the statistics angle is meant for. That's what the data-driven investing or data-driven analysis angle or aspect is meant for. At this stage, we're kind of trying to gain some sort of intuition and, trying to gain some sort of idea as to whether or not it's even worth pursuing this even further. Because, in the real world, for instance, remember that you're going to need to actually collect the data, right? And there are costs associated with collecting data. You either have to pay in time, collecting the data manually, or you need to pay it in dollars or pounds, right? When you buy a database or you buy access to a database. And so there are costs associated with conducting the analysis and with, going a step beyond the investment idea. So it's a good idea to start by asking why this investment idea may even work, right? So what's the logic behind it working? What's the intuition behind it working? And so in the instance or in the examples that we're considering, of course, the core theme is about the relevance or the impact or the importance of things like corporate governance and environmental responsibility and social responsibility. So it's a good idea to then ask why these things matter, right? Do these things actually matter? And, I'm just going to give you an example with the corporate governance side, and you can take a similar sort of approach to thinking about the importance or relevance of environmental responsibility or social responsibility, or indeed any other investment idea that you might want to think about or test at a later date, right? So if we think about the case for corporate governance, if we think about the sort of rationale or the logic for when and why this might actually matter for investments, well, let's think about the case where it doesn't matter, right? So let's think about if we could, for example, plot out the whole world in a single line. Okay, so just imagine that for simplicity, we can think of the world in this incredibly simple way, in this sort of straight line. And on the left-hand side of the straight line, you have one extreme, the extreme where the world has total trust. Okay, there's no lies, there's no fraud, there's no scandals, there's nothing dodgy in this world, right? There's complete and utter total trust. Everyone trusts one another, no one lies, everyone is trustworthy. So, it's a totally trustworthy world. It's a world where trust prevails above and beyond anything and everything else. And since we're considering extremes, let's consider the other extreme where we have total distrust. Right, so a world where no one trusts anyone, everyone's being fraudulent all the time, there are scandals galore, left, right and centre, and there's no value in trust because no one believes a word of what the other says. So if we think about the world in these kind of extreme cases where you've got total trust and total distrust, well, in the case of total trust, corporate governance is not needed. Right? Because why do you need governance? Why does corporate governance exist? It exists to put companies in line. It exists to hold companies accountable, to make sure that they work in the interests of shareholders, to make sure that they don't take part in fraudulent activities. But if you are in a world where there's total trust, then the company isn't going to conduct fraud to begin with. Right? This is an extreme. I'm not saying this is representative of the real world. Right? I'm just saying let's think about a world where there's total trust. And if we are in such a world where there is total trust, then you don't really need to hold companies accountable, and you don't need to put in all of these rules and regulations and legislations, because the companies are going to act in the best interest of shareholders. The companies are going to be trustworthy. They're not going to lie, they're not going to cheat, and they're not going to do dodgy things. Right? So in a world with total trust, however unrealistic that seems, but in that world of total trust, corporate governance would not be required. And if we lived in that sort of world, then of course we don't really need to go any further in testing and sort of validating this particular notion that corporate governance matters, right? Because in this particular world where, you've got total trust, corporate governance would not be needed. And so it wouldn't matter. It's actually a similar thing in the case of total distrust, and this may seem a little bit counterintuitive, because you might think, well, hang on, if we're in a world where total distrust prevails, where no one trusts anyone, right, and everyone's conducting fraud left, right, and centre, then surely we need corporate governance. Well, I mean, the problem is that if you're living in a world with total distrust, then no one's going to believe your corporate governance sort of due diligence, right? So imagine that you're in a world with total distrust, where no one believes a word of what anyone says. Then if you go out there and you do all of these, ethical things, for instance, and you follow the corporate governance regulations and rules to the dot, to the letter, it really doesn't matter, right? Because people aren't going to trust you. They're not going to believe that you are, in fact, following these corporate governance rules and regulations. And so, although you would think corporate governance is needed in this kind of world, because people wouldn't believe it, it's kind of redundant, right? So you probably don't need corporate governance because no one's going to take it seriously anyway. So in a world with total distrust, then corporate governance is probably redundant. And if we did live in a world with total distrust, then of course, pursuing this idea any further is probably not really worth our while, right? So it really wouldn't make sense for us to then go out and collect all that data and do all of that labor and work hard in conducting our analysis, because we probably won't find anything in the data to begin with. Now, these are extremes, right? A world with total trust and a world with total distrust. In reality, at least at the time of recording, the world we live in is neither one where total trust prevails, nor is it one where total distrust prevails. Of course, we're somewhere in the middle, right? What I like to call skeptical trust. So we don't trust blindly, but we do trust to an extent. And in this sort of world, we can kind of make the case for the relevance of corporate governance, right? And of course, I'm saying it's probably relevant because, well, how do we know until we actually test it out in the data? right? But if we agree that we live in a world that has some sort of skeptical trust, where we believe certain things subject to certain evidence and we disregard or disbelieve other things, then, there can be a case for corporate governance being relevant, and therefore there can be a case where, investing in firms with good governance may actually be a profitable strategy in the long term. Whether it is a profitable strategy is yet to be seen. But at this stage, if we agree that we live in a sort of skeptical world, or a world with skeptical trust, then we can say with some reasonable certainty that it's at least worth exploring this idea a little more and going a little bit further. Okay, so this is how we can go from, here's an investment idea that may well be crazy to, well, here's why we think the investment idea may well be relevant. Okay, now importantly, determining whether an investment idea might be relevant, or determining the relevance of an investment idea or an investment thesis or a hunch, if you like, is also very much a function of who you speak with, right? So for example, if you speak with someone who has a corporate governance background, or someone who works within the realms of corporate governance and is a proponent of corporate governance, then guess what they're going to tell you about the relevance and importance of corporate governance? Of course, they're going to tell you that it matters. Of course, they're going to tell you that it's important, right? They kind of have to, because, that's their job. If they tell you that it's not important, then there's questions about whether they should have their job, right? What's the relevance of their job? Equally, if you speak to someone who believes in total free markets, a world without regulations, a sort of Adam Smith invisible hand where the market kind of takes care of things on its own automatically, then that person will likely tell you that corporate governance is completely irrelevant, right? So the relevance of your investment idea or thesis can, and often does, depend on who you speak to or who you speak with. It can also depend on what your investing goals are, right? So maybe you personally don't care about corporate governance whatsoever. You personally only take part in event-driven investment strategies, right? So you don't particularly care about firms with certain characteristics or attributes. You don't care about things like value investing. You bet on a political catastrophe, for instance, right? Or a political success. You bet on certain macro events, and, that's how you invest your money. And if that's how you invest your money, then something like corporate governance may not be necessarily relevant to you, right? And you might say, well, it doesn't matter for investing. And, it probably is true in your case. It doesn't necessarily matter for, some sort of political calamity. And again, I want to be careful here because, of course, the people with a corporate governance background will, of course, be saying that corporate governance matters even for politics, and, it can prevent political catastrophes and calamities. The point I'm trying to make is that the relevance of an investment idea or thesis can vary depending on who you speak with and what your individual investing goals and indeed your investing styles are like. It can also depend on when you're looking at the investment idea, right? So there can be time-varying effects. Look at the importance of corporate governance soon after a scandal, and all of a sudden it's almost certain that more people will agree it's important. Look at the importance of corporate governance at a time where there hasn't been fraud for, say, a decade, then people might well say, well, it doesn't really matter, right? Because we don't tend to have frauds very often, or we don't tend to have frauds in our country, right? Similar story with, say, looking at the impact of, say, climate change, right? Or environmental effects. If we were asking this question or posing this investment idea in, say, the 1970s or the 1980s, we'd have probably been laughed at. But, in the 2020s and beyond, posing this sort of investment idea, or the idea that, environmental policies matter, is taken quite seriously, right? And people will at least listen to what you have to say before dismissing you, automatically. So again, the relevance of your investment idea or thesis can vary depending on when you're looking at or considering that investment idea. Now, despite the variations in the relevance of factors, and despite the variation in the types of investment ideas and thesis we might pose, in the context of investments and as investors, I think it's reasonable to say that the core focus of any investment thesis is ultimately in some form, in one way or another, on the returns of securities and or their risk. Right? So we're evaluating an investment thesis in the context of returns and or risk. So in our corporate governance example, for instance, we're saying or, posing this idea that firms with good governance make better investments, right? And so that's really in the context then of returns and possibly even risk, right? So we're saying if these firms perform better, then we expect them to earn us higher returns. Or, if these firms have better governance, then maybe they're less risky. Right, so we're posing these different and various or varying investment ideas, but the context is within the returns and risk sort of spectrum or realm, if you like, of investments. Now, perhaps the only real exception to this would be if, for instance, you're an environmental investor or you're a sustainable investor or an ethical investor. And if you're this type of investor, then firstly, hats off to you. And secondly, these types of investors aren't only concerned about returns and or risk, right? For them, it's about investing in companies that meet certain ethical standards or that meet certain environmental standards, right? So they have principles and they invest with those principles in mind. Now, I do, of course, highly respect ethical investors, and I think the world needs more of them. But from a teaching standpoint, from, displaying data-driven investing or, showing you how data-driven investing works, bringing in this other realm of, ethical investing decisions can bring in added complexities into the equation, right? Because how do you put in constraints for whether an investment is ethical or not, right? So how do you actually put that in the data? It's all doable, but, it just brings in additional complexities in what we're trying to achieve or what we're trying to do, which in this context is to go from an investment idea or thesis to, testing and validating that idea or, strictly the hypotheses statistically. And so in our specific context, then, we're only interested in exploring the impact of, corporate governance and environmental and social responsibility on returns and or risk. The point is we're only thinking about these things purely from an economic or investing standpoint. We're not thinking about these things from, an importance of climate change considerations or from the perspective of, the importance of corporate governance from a moral standpoint or a societal standpoint. We're not thinking about things in those perspectives, although, again, they are important and people do need to think about these things. But do remember, our context is data-driven investing. Okay, and so all we're trying to do is go from an idea that we have, a hunch or notion that we might have, and testing and validating that idea statistically, right? That's what our aim is in the context of this course and in the context of what we're trying to do. In your real-world investing, do think about the ethical consequences of your investment decisions. Okay, so if we agree that we're thinking about these things purely from an economic and investing standpoint, then what we're saying is if these factors matter, so if governance matters or if environmental responsibility and social responsibility matters, well, then we want to be able to see their impact in the data. Right, so we want to be able to see their impact on the returns of stocks or the returns of portfolios. And we want to be able to see their impact, perhaps, on the risk of stocks, right? Again, this depends now on what the core hypothesis is. But the point is that we know we're kind of going to have a hypothesis that relates to the returns and or risk of securities, right? Because we're thinking about this from an investing perspective or from an economic perspective. And so in that context, when we're considering an investment idea, if it matters, well, then we want to see if it matters in the data. We want to be able to see the impact on returns and or risk in the data. So it's not about my opinion or your opinion about the relevance of a factor. It's about the statistical validity, right? It's about validating whether or not this particular factor matters in the data by leveraging the power of statistics. Now, how do we actually do that? Well, of course, we formalize the investment idea and transform it into a testable hypothesis, and then test the core hypothesis statistically, or indeed test multiple hypotheses statistically. Now, we're going to talk about, creating this testable hypothesis from scratch in another video, but I do want to highlight the fact that it's not quite a transition from investment idea to testable hypotheses. Right, so there is a little bit of a step just before that, and that involves expressing our investment idea in the form of a research question. Right, so we take our investment ideas or investment thesis and we sort of phrase them as a research question or multiple research questions. And this is useful and helpful to do because it really makes the transformation into a testable hypothesis much easier and much more straightforward. Right, so it's much easier for us to take a research question and convert it into a testable hypothesis than it is for us to take a long-winded, expressive investment idea and create a testable hypothesis from that. And so if we think about taking our investment ideas about corporate governance and environmental responsibility and social responsibility, taking those investment ideas and converting them into research questions, then it might look something like this, right? So we might say that our first and fundamental research question is there any relationship between corporate governance, environmental and social responsibility, and stock returns and or risk, right? So is there some relationship there to be explored? Because, what did my friend say? He said corporate governance, can make for better investments. Firms with good governance will make for better investments. And, anecdotal evidence suggests that firms with environmental policies, good environmental responsibility and good environmental policies tend to perform better financially, right? And it's the same kind of story with corporate social responsibility. And so if these notions have any merit, then we should be able to see some sort of relationship between these factors and stock returns or risk. Right, so we've moved slightly away now from an investment idea or, a hunch to a slightly more formal research question. Okay, and from this we can then take things a little bit further and say, well, our second research question is that if there is a relationship between those factors and stock returns and or risk, then can it be exploited to earn abnormal returns? And abnormal returns is just a very fancy way of saying returns over and above what the market can deliver, right? So can we beat the market, if you like, or can we earn a higher return than what the market portfolio can offer? Okay, so again, this is if there is a relationship visible in the data. Can we then, for instance, create an investment strategy to profit from this relationship? Can we earn alpha, which again just means can we earn a return that is greater than what we could earn by just investing our money by buying the market portfolio or buying a stock market index? Now, with these sort of clear-ish research questions in place, we can now take things forward by formalizing our idea, or strictly, formalizing these research questions into a testable hypothesis or multiple testable hypotheses. And again, this isn't something I've already done, right? So I'm going to think about creating the testable hypotheses going forward because, like I said, I'm kind of doing these things as I go along to try and simulate the real-world investment research and real-world data-driven investing environment where we kind of think about these things as we go along and we ask a variety of different questions to which we don't always have the answers then and there. But of course, we go out there and we explore what's in the data and find answers to our questions. Importantly, while we're working with one specific example investment idea, to do with corporate governance and environmental responsibility and social responsibility, you can, of course, use the same approach that we've taken and apply it to any other investment idea or investment thesis that you might have. Right? Fundamentally, the idea is go out there and explore the different sources of information, let your imagination flow and let your creative juices flow so that you can come up with these different investment ideas. Then go out there and, formally express your investment idea as a research question before then further formalizing it as a testable hypothesis. And then, of course, go out there and test it once you've collected and cleaned the data. All right, in summary, we learned that investment ideas can, of course, be sourced from a variety of different places, including, of course, experience, and just reading and observing forums or news articles or, reading what's out there in the research literature and, just simple conversations with a mate or a friend or indeed just someone you meet and have an interesting conversation with. Regardless of where you get your information from, and regardless of how far-fetched or how intuitive the investment ideas may seem, it's important to develop the thesis or develop the idea by considering why it might matter and under what circumstances it should matter, as well as what circumstances it shouldn't or wouldn't matter. Finally, of course, we learned how, generally speaking, although there can, of course, be a variety of different investment ideas and theses, validating those ideas will involve assessing their impact in one way or another on security returns and or risk, right? And again, this is in the context of data-driven investing, right? So we're just thinking about things purely from an investing standpoint, purely from an economic standpoint. But, the data-driven side is just one side of the coin. You do want to think about the ethical consequences and the ethical impact of your investment decisions, right? And that is, of course, something that is a tad bit harder to do purely using quantitative methods. It's something that, of course, can be done to some extent, using quantitative methods. But it is, of course, about thinking about things on your own, within your own moral thoughts and your moral principles and, of course, your moral beliefs. Okay, but again, of course, importantly, remember that in our context, in our case, we're thinking about things purely from a data-driven environment or data-driven perspective in the context of investing and, economic gain. Okay, hopefully all of this makes sense. I appreciate this video has been pretty long, but I did want to give you a sort of fair overview of what it takes to, come up with a sort of investment idea just on the fly, using these different sources of information and then developing that idea, right? So converting it into a research question and sort of formalizing the investment idea and getting it ready for the next stage where we're going to create a testable hypothesis from the idea / research question. All right, that's enough for me for now, though. Have a go at the quiz, and I'll see you in the next video.